Welcome back to the channel, guys. I have a cracking video for us today. I did a previous video on the back test, and I thought it would be interesting to do one on kind of investment returns by asset class over a very long historic period, 2005 to 2025. So what we're going to look at today is an interactive look at almost like a periodic table of investment returns, showing what goes up must eventually come down. So just a little bit about the data. For each of the 12 asset classes we're working with, the annual returns, as I said, from 2005 to 2025, note that all the returns analysis are real total return values, meaning that they are adjusted to take into account inflation and the reinvestments of any dividends. The values of 2005 to 24 are based on a full year basis ending December 31st, 2024. Obviously, at the time of recording this video, we're still in 2025. So the values for 25 are year to date as of October 2025. So if we look at the first kind of section, what we're going to look at is the ranked asset class returns. It's no easy feat, right, to pick a winner in any given 1 year. The asset class rankings appear to be randomly tossed about over time, with the top performer in 1 year often falling down to the middle or even the bottom of the table in the next year. What's fascinating as a takeaway is 11 out of the 12 of the asset classes have been a top performer in at least 1 year on record. High yield US bonds being the odd man out. On the flip side, 9 out of the 12 of the asset classes have been the worst performer at some stage, whether that be Canadian stocks, Canadian bonds, high yield US bonds, being the only assets to avoid that dishonor. So if we start to look at the table now, we can see going back historically. Now, where we are currently year to date 2025, which is probably where most people are interested in where we are today. And as I said, this is kind of year to date and around end of October. Gold has obviously been the best performing asset class, and a lot of people have seen all the things in the news around gold. Despite it taking a bit of a dip recently with people selling on all-time highs, it's still up 14%. Followed by US large cap, emerging stocks, international developing stocks, US high yield bonds, cash T-bills, then Canadian stocks, US bonds, Canadian bonds, international bonds, US small cap, and then REITs, which are actually negative. Now, I will go into what the definition of each of these asset classes is in the next section. What's interesting is that a lot of the best performing in a given year is also related to what's happening in the economy. And again, I've got a section where we look at that and we actually go into a particular year and we can actually see what's happening in that year potentially, and therefore what the leaders are within that time period, which is quite fascinating. So when we get to that section, I think it's quite revealing. Now, obviously, if we look at just rank number one over across many years, what we're seeing here is no particularly obvious pattern just by looking at this initial periodic table view. 2024 REITs were on a tear, 17.6%. 2023, we saw US large cap at 26%. But what you'll also notice is the winner in that particular year is also dependent on what's happening in the rest of the asset classes in terms of their return. So if we look at 2025, gold's at 14%, 2024's winner REITs was at 17.6%. But if we look at 2023, US large cap, that was 26.3%. That was actually really good. But then if we go look at 2022, most of us know what happened in 2022. Cash was the best performing asset after inflation, but it was only 1.2% return. So we can see over time, just because it's a winner doesn't mean it's a massive winner in terms of total returns for that time period. And as I said, we can see no obvious trend here where one is outwinning any particular asset class. And we can keep going right back up, right back to history in terms of where we are looking. So right back to 2005. Now, obviously, the kind of incumbent of new platforms and new investing vehicles have made it a lot easier for people to invest in markets since 2005. So we're probably seeing some of the money flows change as well in terms of the asset allocations that people are also investing into, which is driving some of those performance in some of those areas. If we kind of look at what's typically also similarly the worst performing, again, there is no outlier. What we can see in recent times, REITs have typically performed a little bit poorly in the last sort of 4 or 5 years. But what you will see is that we can see that typically cash is nearer the bottom. And that's no great surprise to a lot of people that understand investing in growth and understand inflation is kind of eroding the value of money. And we can see that with the cash side, where typically cash is quite predominantly nearer the bottom or at the bottom quite often. So it's unusual, in fact, to see cash near the top. It can happen. But what we will typically check in a second is when that typically happens, there's something happening quite drastically in the wider economy. And so if we start to look at this from a kind of a year in focus perspective, I mentioned that typically stocks are following a particular pattern when we look at the market. Here, if I just look at where we are today in 2025, year to date, gold is the standout performer. Geopolitical tensions and inflation concerns linger. Stocks have posted modest gains while REITs and small caps have lagged behind, and cash continues to provide a solid, safe return, and rates remain elevated. What's interesting here for me this year has been REITs' performance has been quite poor from a general perspective. If we go back to 2022, the inflation shock, central banks hit rates at the fastest pace in decades. Both stocks and bonds, a rare combination, had one of their worst years in history, and gold and cash were the best relative performers, losing the least. But we can see how in really bad years we can get a situation where everything is typically down. I want to pick again when we had the pandemic kind of year. A flash crash occurred in March, which was followed by an unprecedented government central bank response, fusing almost a massive rally in stocks led by US and gold. REITs suffered again as offices and retails were shut down, but it's interesting to see how all the other asset classes pulled through there. I want to look at another period in time where we looked at 07 and 08, where there was another kind of crisis in the markets. And again, the first signs of trouble, while emerging markets and gold posted great returns, REITs and small cap stocks again signaled the start of the kind of subprime mortgage crisis. And we can see that kind of relevant in terms of the market and the spread. What we can also see is, again, that continued in 08. The global financial crisis really kicked in 08, and nearly all risk assets collapsed. Emerging stocks and REITs were hit the hardest. Traditional safe havens like bonds, whether they be international, Canadian, and gold, kind of provided the positive returns, showing that value of diversification within a portfolio. What we can also see is in the mid-years, we can also get mixed years as well, where the US economy and large cap stocks outperform the rest of the world, REITs bounce back, and international stocks and bonds typically have struggled in 2014. So we can see that when a sector gets hit very hard, very quickly, you start to see those rebounds occur. But we can also see how important it is to have a portfolio that's balanced. And it's not about having 100 stocks. It's about having maybe fewer stocks, using indexes to help you balance, whether that be an all-world index. And I've done a video on the all-world, whether it be having a mix of having a concentration and balancing some of the large cap with bonds, or having REITs in your portfolio. Historically, I've always called out that I'm not a big fan of certain sectors. Bonds have typically, for me, been underperformers over a long period of time in terms of total return. So I'd rather put it in other asset classes that I could hedge against, for example, gold or commodities. And I feel like with these income kind of products coming to market, where you're able to potentially hold gold through an ETF underlier, but also gather some income from it. That's always been the problem with gold, is you're reliant just on the pure price gain of gold. But if you could have a bit of a cover call strategy, overlay option strategy on it, it's also generating you a little bit of income. And gold has always typically shown itself to be a hedge against the markets when they are really taking a hit. So I thought I'd pick a few years there just to show what happens when you had the financial crisis, what happened when we had the pandemic, but also what's happening in good years and also years where things potentially a bit mixed as well. Let me know, guys. I should try and find a way of sharing this data out there, maybe, so that people can flip to a year that maybe they're interested in particular to see what happens. Because as I said, this goes back all the way to 2005. I wanted to do a growth section. If you just literally just had a pound in there, where would your pound kind of sit? And we can see over time where the pound would end up. So in 2005, US large cap, we know, has done well with the bull of AI growing, or the tech boom. But we can see most assets have done pretty well in 2025. There hasn't been a terrible performing asset this year. Arguably, cash we'd expect not to do great if everything else is doing great, but it's a good year. And this is the thing that people forget, is that when times are good, they can be good, but when they're bad, they can be very bad. And that's something people are going to have to get used to. If we look at the '08 kind of crisis, and everything is lost value. So we can see how you've got to be able to swallow the drawdown. When you're looking at a growth investor particularly, you need to be a lot more versatile in your ability to handle the swings in the market and know that things will recover. And this is why I want to do this video, because I want people to understand that markets do recover, sometimes quicker, sometimes slower, and there could be advantages to different styles of investing: growth investing, value investing, income investing. But it's about understanding what the markets are genuinely doing and why a balanced portfolio is often encouraged, because each asset class, there is no overall winner in that sense. But most asset classes will go up over time, accounting for reinvestments and accounting for inflation. So if we were to look at this from a long-term performance perspective, and again, I've gone even further back now, 1985 to 2024, which investment asset class have had the highest and lowest returns over that whole period of the original analysis? So the best performers were US large cap stocks at 8.6% per year. I don't think there was any great surprise in that. US small cap stocks at 7.6% per year. What surprised me personally was emerging markets. They did 7.3% per year, which is actually more than I anticipated. But it also tells me why the all world funds have done very well, because they are heavily weighted towards the large cap stocks in the US market, but they do have emerging market exposure. Worst performing, and the top one doesn't surprise me, I actually did a separate personal back test of 40 years worth of bond performance, and it was less than 3%. And this is why I don't have bonds in my portfolio personally anymore. So international bonds is 2.6% per year. Gold was interesting. Over this period, it was actually one of the worst performers at 2.3% per year. So it makes me wonder, is that because the markets have done so well historically and people are just investing their money there? Or is it simply because people are just willing to take more risk and there's not enough going into hedging against markets? Or could it be that gold is undervalued and that's why we've seen a bit of a rally this year? I'll be curious to put in the comments, guys, what you expected the best performers to be and what the worst performers you expected to be, because there were some surprises for me personally on this front. The cash T-bills doesn't surprise me. Obviously, we've taken into account inflation, so there's going to be, if you just held it in cash. What was interesting is it still gave you something, albeit it wasn't great. So as a reminder, all the values shown here are total returns, including dividends, and as I said, accounting for inflation. So in summary, unsurprisingly, stocks came out on top in pure investment returns, while bonds and other assets lag behind. Again, this data demonstrates the investing cliche that higher risk leads to higher returns. Okay, a bit about Bitcoin, because I'm sure it's going to come up in the comments at some point. So most of the keen eye would have consciously noticed that Bitcoin doesn't appear in any of the statistics above. But I feel compelled to address this given the exponential gains in value, popularity of cryptocurrencies in recent years. Bitcoin has a relatively short trading history, okay, with market pricing for Bitcoin only starting in 2010. In contrast, the post-analysis asset class returns go back to 1985. Okay, the asset table was shorter, but I did a full back test. So the total market capitalization of Bitcoin, and I'm going to use the word in quotes only, $2 trillion at the time of writing. Okay, so I went back to January 2025, which is quite small compared to other asset classes. By contrast, like the US stock market is a total market cap of $54 trillion, so 20x larger than what Bitcoin is. With that in mind, Bitcoin is still a new asset and a relatively small asset in the grand scheme of things. And it could be argued that it should be compared against specific single company stocks like an Nvidia, Apple, or a Tesla rather than against the broader market and bond markets as a whole. However, saying that, it's become increasingly tough to ignore the performance of Bitcoin and other cryptocurrencies. So if you look at a summary of Bitcoin's performance in recent years and how it would stack up against the major asset classes being tracked in this, if we look at 2024, 122%, it was the best performing asset. 2023, 155%, again, best performing asset. 2022, negative 64%, worst performing asset. 2021, 60%, best performing asset. And 2020, 303%, best performing asset. So Bitcoin's price is increasingly and incredibly volatile and would fall either at the top or the bottom of the rankings in any of the recent years that it was around. One thing I would say is that I've done a video separate to is Bitcoin a hedge against the market? So I recommend people go and watch that separately. But I thought I would include Bitcoin and cryptocurrency because I know it would come up. And in future videos around sort of asset classes and comparisons, I may fold it into the main analysis because I think over time, it probably is going to deserve that spot. So I wanted to go into what was driving each of these asset classes, what was behind them when we talk about US large cap, what do we mean? So US large cap is the S&P 500 index, okay? So the 500 of the largest US companies which span many different industries and account for 75% of the US stock market value. So number of holdings is 500 stocks. Risk out of 5 is 4, and the CAGR return is 9.8 between 2005 and 2025. And we often hear this bantered around that the markets do around 10% a year, and this is typically where that number comes from. When we talk about US small cap, we're talking about broad exposure to smaller sized US companies. Number of holdings, 1,400 stocks. Risk out of 5 is a 5. And again, it's not done badly here. The CAGR over that period has been around 7%. If we look at now international development stocks, developed markets, exposure to large, mid, small capitalized companies in developed markets outside of the United States now, again, we're talking about 4,000 stocks here, so a huge amount. We've got a CAGR of 5%, which again is really good for a risk factor of 5. If we now look at just emerging markets, so these are stocks of companies located in emerging markets around the world, such as Brazil, Russia, India, Taiwan, and China. And again, we're talking about a basket of 5,000 stocks here. Risk out of 5, again, is 5, and the CAGR is around 6.1%. Canadian stocks, so it covers around 95% of the Canadian stock market. So the Canadians version of the S&P in effect is around 200 stocks. Risk out of 5 is 4, and the CAGR is around 7%. US bonds, so these are investment grade bonds. The funds invest in US treasuries and mortgage-backed securities, about 10,000 in this case. Risk factor now drops to 2. Return is around about 3%. US high yield bonds now, so again, diversified portfolio, medium and lower quality US corporate bonds, often referred to as junk bonds. Again, around 600 bonds, a risk out of 5 is 3, and a CAGR is around 6.3%. Now we look at international bonds. So these are exposure to non-US invested grade bonds, track the performance of an indices that includes international governments, agencies, and corporate bonds, mostly from developed countries now, but also from emerging markets. Huge number here, 6,000 bonds. Risk rating drops to 2 now, but again, returns CAGR of around 1.4%. Canadian bonds, again, these are exposure to Canadian invested grade bonds. So federal, principal, and corporate, around 1,200 bonds, risk rating of 2, but around 3.4%. Now, if we look at cash, so this invests in short-term US Treasury bills and other debts that are sponsored, guaranteed, or owned by the federal government. It's typically 40 odd. Risk rating is the lowest it can be 1, and the CAGR is 1.6. If we look at REITs now, investment into real estate investment trusts, companies that purchase office buildings, hotels, and other properties, approximately 200 in that basket. It's a risk rating of 4, but a return of almost 6%. And then we've got gold, which seeks to reflect the performance of the price of gold. Obviously just gold in there, so just 1. It doesn't really have a risk rating associated typically, and its return has been 8.9%. So we can see that dependent on your level of risk, with the exception of gold or commodities in this particular instance, the risk is coherently linked to the level of return. For the higher risk levels, you are genuinely getting better returns. Now, that doesn't always mean that's going to be the case, but in this particular time period, that is what has happened. Okay. There is some interesting things where you could argue there's some close trade-offs for taking slightly less risk when we talk about bonds potentially, where you might be thinking, actually, do you know what? High yield bonds, I'm getting 6.3% for just a little bit extra risk versus just having normal bonds at 3%. So half the yield for slightly extra risk could be a good balancing act there. But it is interesting to see that correlation. I did a kind of deep dive into single asset classes and what happened over that time period. Again, I just want to focus on when we did have the two crucial, and I picked the US large cap deliberately because it's easier to demonstrate this. Over this time period, we talk about the median being around 15%, the average being around 11%, the CAGR, as I said, is around 10%. The max we can see is 32 and a bit percent, but we can also see the worst is around 37%. But what I want to really highlight is that when there are real big things happening in the world, like in 2008 with the financial crisis, and like with the pandemic where we saw the drops, we can see the impact of that on all the other years we've had positive returns, but those drawdowns have been fairly big when they have occurred. So again, we've had a good time in the markets, arguably over the time period of the last 20 years. It'll be interesting to see how much of that continues going forward. And we always hear people say the stock market's overvalued, but I did a video on why backtesting is still quite important, even if it doesn't always indicatively drive future performance. So again, go and watch that video. I deliberately timed these videos almost back to back so that people could watch that one and then come to this one. Again, I've got all the asset classes here by analysis, so you could go in and I could pick gold as an example, and you can go back and look at all of this data. As I said, maybe I'll do a more in-depth video if anyone wants to have a look at the data, or maybe I might be able to post this somewhere so people can actually go and have a look at the data themselves. Guys, if you're finding this useful so far, please hit the like button. It means a lot to me. Subscribe. Again, a lot of effort's gone into this particular video today, putting all this together and sharing it. Okay, if we look at the correlation aspect between asset classes, I think this doesn't get talked about enough, which is what is the correlation of something? Is it directly correlated? Is it indirectly correlated? And what we can actually see here is there is some counter correlation. So the idea here being, as one kind of relationship moves, the other one either follows it or it moves in the opposite direction. So the values shown here are a correlation coefficient. Okay, it's sometimes referred to as a Pearson's R value. So this measures the strength of the relationship between each of the pair of the asset classes. So a value of 1 would be a strong relationship, 0 would be absolutely no relationship, and negative would be a strong negative relationship. And the key takeaways here are all categories of stocks have a fairly high correlation with each other. Okay. Bonds have a minimal correlation with stocks, closer to 0, and gold has a slightly negative correlation with some of the other asset classes here. So we can see that generally when you're looking for the best hedges against markets, you're looking at gold and bonds typically. And this is why the 60-40 is often bantered around. We have 60% in stock and 40% in bond. Now, again, nothing I talk about today, it's all for education. None of it's financial advice, but hopefully I'm sharing some data so you can make some informed decisions for yourself based on what you're seeing here today. So kind of what's my final thoughts and key takeaways? And I just want to do prediction is futile in a way. It's hard, perhaps impossible almost, to predict which asset class will be the best performer in any given year. There doesn't seem to be any rhyme or reason to the annual rankings per se. Time is your ally though. Investment returns are far more reliable if you have a long time horizon. The risk of losing money is much higher if you're only investing over a 1-year period or a short time period. Diversification works. Diversification has a clear benefit. Allocating a portion of your portfolio towards bonds will often cushion some of your losses in years when stocks tumble. The optimal strategy. All in all, it's my firm belief that the optimum investing strategy relies on a few simple steps. Invest in a diversified passive portfolio, stay invested over the long term, and rebalance when necessary. Hopefully you found this useful. Thanks to the 100% Club again for getting to the end of this video. Again, disclaimer that nothing I shared here today is investment advice. Do your own research as always. This was just for entertainment purposes only. And I'll catch you on the next one.